At 9:47 a.m. Eastern on January 30th, 2026, silver futures dropped from $120 to $84 in less than 4 hours. That's $37 per ounce erased. That's a 30% collapse. That's approximately $12 billion in market value vaporized, faster than most people can finish their morning coffee. This is the largest single-day percentage drop since March 27, 1980. That was the day the Hunt brothers' empire collapsed, the day COMEX implemented Silver Rule 7, and the day the entire precious metals world learned that exchanges will change the rules mid-game when the wrong people start winning. 46 years later, history didn't repeat. But it rhymed perfectly. If you think this was just profit-taking after a massive rally, you're seeing the surface. If you think this was algorithms gone haywire, you're closer, but still missing it. What happened on January 30th was a coordinated deleveraging event designed to accomplish one very specific goal: save the banks that were short silver from the largest delivery crisis in COMEX history. And I'm going to prove it to you. I'm going to show you the 3 triggers that caused this crash to happen at this exact moment, the specific institutions that profited while retail investors panicked, and most importantly, whether this is the buying opportunity of the decade or the first domino in something far more dangerous. Because the silver market didn't just crash yesterday, the silver market broke. And what's broken doesn't always get fixed the way you'd expect. Let me give you the raw numbers first because the data tells a story that the headlines won't. Silver opened January 30th at $115.43. By 8:30 a.m. Eastern, it had already slipped to $99.04, down over $20 from the previous day's close. By noon, it had touched $84.63, a 26.9% intraday decline according to Trading Economics data. Some platforms recorded lows near $84, others showed $95 as the floor before the bounce. The discrepancy itself tells you something important. When paper and physical markets diverge this violently, when different data providers can't even agree on what the price was, you're witnessing a market in distress. Volume was extraordinary. On January 26th alone, the iShares Silver Trust ETF, ticker SLV, saw a turnover of nearly $40 billion, according to Bloomberg. That's comparable to the SPDR S&P 500 ETF, the most liquid instrument tracking the 500 largest companies in America. Silver, a single commodity, traded with the same intensity as the entire large-cap U.S. equity market. That doesn't happen in normal markets. That happens when institutional players are repositioning at scale, when the smart money knows something the rest of the market is about to find out. Here's what makes this crash historically significant. Silver had just completed 9 consecutive months of gains, its longest winning streak in years. It had risen 144% year over year. It had broken above $100 for the first time in history just days earlier, and then surged to $121.67 on January 29th, an all-time nominal high that exceeded even the inflation-adjusted 1980 peak, depending on which calculator you use. The metal was up over 40% for January alone when the reversal hit. The mainstream narrative is already being written. Reuters called it profit-taking and a stronger dollar. CNBC pointed to technical breakdowns triggering algorithmic selling. Bloomberg mentioned the Fed chair nomination creating uncertainty. And all of these things are true in the most superficial sense. Yes, people took profits. Yes, the dollar bounced. Yes, Trump nominated Kevin Warsh to replace Jerome Powell at the Federal Reserve on the morning of January 30th, creating momentary uncertainty about monetary policy direction. But these explanations describe the kindling. They don't explain who lit the match or why they lit it on this specific day at this specific hour. Consider the context that the mainstream coverage conveniently omits. On January 1st, 2026, China implemented the most aggressive precious metals export controls since the rare earth restrictions of the previous decade. Beijing reclassified silver from an ordinary commodity to a strategic material requiring government licenses. Only 44 companies received authorization to export silver over the next 2 years. This matters because China accounts for 60 to 70% of global refined silver exports. The single largest source of physical silver to Western markets was just throttled by government decree. At the same time, COMEX registered inventory, the silver actually available for delivery against futures contracts, had fallen to approximately 30 million ounces. In just the first 2 weeks of January, 33.45 million ounces were physically withdrawn for delivery. That's 26% of the registered inventory gone in 7 days. The paper-to-physical ratio, the amount of silver promised on contracts versus the metal that actually exists in deliverable form, had stretched to 356 to 1 by some estimates. For every ounce of real silver in COMEX vaults, 356 ounces had been sold on paper. This is the backdrop against which the crash occurred. Not a market that was overextended and due for correction. A market that was on the verge of exposing the largest naked short position in commodity history. And then, right at the moment of maximum danger for the shorts, the price collapsed 30% in a single session. Coincidence doesn't explain that timing. Let me show you what does. Every market crash has proximate causes and ultimate causes. The proximate causes are what the headlines report. The ultimate causes are what those headlines exist to obscure. The January 30th silver crash had 3 distinct triggers, and when you see how they align, the picture becomes impossible to ignore. The first trigger was the margin call cascade, and it began before American traders even woke up. Here's how leverage works in futures markets. When you buy a silver contract on COMEX, you don't pay the full value of the silver. You put up margin, typically 5 to 10% of the contract value. If the price moves against you, you must post additional margin or face liquidation. Liquidation means the exchange sells your position at market price, whether you want to sell or not. Forced selling into a falling market accelerates the decline, and accelerating declines trigger more margin calls. It's a feedback loop that can turn an orderly correction into a waterfall collapse. On January 13, 2026, the CME Group changed how they calculate margins for precious metals. Instead of fixed dollar amounts, they moved to a percentage of contract value system. Silver margins were set at 9% of contract value. At $50 silver, that's $22,500 per contract. At $120 silver, that's $54,000 per contract. As silver rallied through January, margin requirements automatically increased. Traders who were comfortably margined at $80 silver found themselves under-margined at $110 silver without the price moving against them at all. But that wasn't all. Starting December 26, 2025, the CME issued a series of explicit margin hikes on top of the percentage-based system. Advisory 25393 raised maintenance margins for March 2026 silver contracts from approximately $22,000 to $25,000 per contract, a 13.6% increase. Then another hike, then another. By the time silver peaked on January 29th, margins had been raised approximately 30% in cumulative terms across multiple announcements. Each hike forced traders to either wire more money to their brokers or face automatic liquidation. Many couldn't move funds fast enough. Many were already stretched, and when the liquidations began, they fed on themselves. According to market estimates, tens of thousands of contracts were liquidated in the pre-market and early trading hours on January 30th. That's hundreds of millions of ounces hitting the market as forced selling, not voluntary profit-taking. The second trigger came from Shanghai, and it exploited the gap between time zones. The Shanghai Futures Exchange closes at 3 a.m. Eastern Time. On January 29th and 30th, silver on the Shanghai Exchange showed significant weakness as Chinese traders reacted to the margin increases and the implementation of export controls. When Shanghai closed down sharply, traders with positions on both exchanges faced a choice: add margin to their COMEX positions or liquidate before American markets opened. Between 3 a.m. and 6 a.m. Eastern, COMEX electronic trading saw abnormal volume. Positions were being dumped into thin liquidity, the worst possible time to sell large quantities. This pre-market selling established the downward momentum before regular trading hours began. By the time the New York session opened, silver was already down over $20 from Thursday's close. The crash wasn't starting, it was already in progress. The third trigger is the one that ties everything together, and it requires understanding who was positioned to profit from this exact scenario. For months, the commitment of traders reports published by the CFTC have shown a massive concentrated short position in COMEX silver held by commercial traders, primarily large banks. The exact size is obscured by reporting categories, but analysts who track these positions estimate that 4 or fewer entities hold the majority of the commercial short interest. These are not hedgers protecting physical inventory. These are institutions with paper short positions that profit when the price falls. When silver rallied from $30 to $120 over the course of 2025, these short positions accumulated staggering unrealized losses. According to estimates from precious metals analysts, the notional loss on concentrated short positions exceeded $10 billion as silver approached its peak. These banks weren't just losing money. They were facing potential delivery obligations they could not fulfill. Consider the math. COMEX registered inventory stood at roughly 30 million ounces. Open interest on silver futures represented claims on hundreds of millions of ounces. If even a fraction of contract holders stood for delivery, the metal wasn't there to deliver. The banks would face the choice between defaulting on contracts or buying physical silver on the open market market at any price, which would send silver not to $150 but potentially to $200 or beyond as they chased a market that knew they were desperate. That's the position the banks were in on January 29th. And then on January 30th, silver dropped 30%, and those same short positions went from catastrophic losses to billion-dollar profits in a single session. I want to be careful here. I'm not claiming to know exactly which institutions coordinated with which regulators to engineer this outcome. What I'm showing you is circumstantial evidence that points in a very specific direction. Margin hikes that disproportionately hurt leveraged longs. A crash that occurred at the exact moment of maximum danger for institutional shorts. A price collapse that converted existential losses into windfall gains for a small number of banks. The last time we saw this pattern was 2011, when 5 margin hikes in 9 days crashed silver from $49 to $30. Before that, it was 1980, when Silver Rule 7 ended the Hunt brothers and crashed silver from $50 to $10. The playbook hasn't changed, only the scale has. When a market moves 30% in a single day, the question isn't just what happened. The question is who was positioned to benefit. Because in zero-sum markets like futures trading, every dollar lost by one party is a dollar gained by another. The $12 billion that evaporated from long positions on January 30th didn't disappear. It transferred. And tracking where it went reveals the architecture of what actually occurred. Let's start with the banks. JP Morgan Chase has been the dominant player in precious metals markets for over a decade. In 2020, they paid a record $920 million to settle charges of spoofing and manipulation in gold and silver futures spanning 8 years. The settlement included admissions that traders placed thousands of fake orders to manipulate prices. The individuals involved kept their bonuses. The bank kept its trading privileges. And the manipulation, by all observable evidence, continued under different methods. According to the Office of the Comptroller of the Currency's quarterly derivatives report, the 4 largest U.S. banks hold over $14 billion in precious metals derivatives. The concentration ratio shows these 4 institutions control approximately 89% of all commercial bank precious metals derivative positions. This isn't a diversified market with many participants. This is an oligopoly where a handful of players can move prices through coordinated action. When silver peaked at $121.67 on January 29th, banks holding short positions were staring at unrealized losses that threatened their quarterly earnings and potentially their capital ratios. A 30% decline the next day didn't just stop the bleeding, it reversed it entirely. Conservative estimates suggest the major commercial shorts collectively gained between $3 billion and $5 billion on January 30th alone. That's not profit from skillful trading. That's profit from a price move that happened to occur at the exact moment it was needed most. Now let's examine the options market, because this is where the evidence becomes difficult to explain as coincidence. In the days leading up to January 30th, unusual activity appeared in SLV put options. Put options are contracts that profit when the underlying asset falls. They're insurance for holders and speculation for traders betting on declines. Volume in short-dated SLV puts, particularly those expiring within 1 to 2 weeks, spiked dramatically in the sessions before the crash. On January 26th, SLV saw nearly $40 billion in total turnover, a figure that rivals the most liquid equity ETFs in existence. Within that volume, put option activity was disproportionately elevated. Someone, or multiple someones, was positioning for a sharp decline with remarkable precision on timing. Consider what this means. If you bought put options on January 27th or 28th, with strike prices 20% below the market, those options were nearly worthless. Silver had been rallying for 9 straight months. The idea that it would crash 30% in 2 days seemed absurd. The premium on those puts was minimal because the probability seemed negligible. Then silver crashed exactly as those puts needed it to crash. Options that cost pennies became worth dollars. The leverage on correctly timed put purchases during this window exceeded 1,000% in some cases. Whoever made those trades didn't get lucky. They had information or influence that the broader market lacked. The CFTC has access to every trade, every timestamp, every account. They know exactly who bought those puts and when. They know which clearing firms processed the orders and which prime brokers provided the leverage. The question is whether that information will ever become public or whether it will be buried the same way previous silver manipulation investigations were buried. In 2008, the CFTC opened a formal investigation into silver market manipulation following complaints from investors and analysts. That investigation lasted 5 years. In 2013, the agency announced it had found no evidence of manipulation and closed the case. 2 months later, major banks began paying billions in settlements for manipulating other markets using the exact techniques the CFTC claimed weren't being used in silver. The investigation was either incompetent or compromised. Neither explanation is reassuring. The regulatory structure that oversees these markets is not designed to protect retail investors. The CME Group, which operates COMEX, has a risk committee that includes representatives from the very banks whose positions create systemic risk. The CFTC's Division of Enforcement is staffed significantly by former employees of the institutions it regulates, and current employees frequently leave for lucrative positions at those same institutions. This revolving door doesn't just create conflicts of interest, it creates aligned interests between regulators and the regulated. When margin requirements are raised during a rally, the official explanation is always risk management, protecting the clearinghouse, ensuring market integrity, but margin hikes during rallies disproportionately harm long positions while providing relief to shorts. When you see margin increases announced repeatedly during a 9-month silver bull run, culminating in a 30% crash that rescues the largest short positions in the market, risk management starts to look like position management. And position management on behalf of specific market participants is another word for manipulation. I cannot prove coordination in a legal sense. I don't have access to internal communications between CME officials and bank trading desks. What I can show you is a pattern of outcomes that consistently benefits the same institutions at the expense of the same counterparties. At some point, the pattern itself becomes the evidence. The most dangerous phrase in finance is, "This time is different." It rarely is. Markets have cycles. Manias have signatures. And the methods used to end precious metals rallies have been documented repeatedly across decades. What happened on January 30th, 2026 fits a template that anyone who has studied silver market history will recognize immediately. Let's go back to January 1980. Nelson Bunker Hunt and William Herbert Hunt, Texas oil billionaires, had accumulated over 100 million ounces of physical silver through the 1970s. They believed correctly that inflation would erode the value of paper currency and that hard assets would appreciate. By late 1979, their buying had pushed silver from $6 to nearly $50 per ounce. They were taking delivery on futures contracts, removing physical metal from exchange warehouses, and creating exactly the kind of supply squeeze that threatens leveraged short sellers. The response from exchanges and regulators was swift and coordinated. On January 7th, 1980, COMEX implemented Silver Rule 7. This rule didn't just raise margins, it prohibited new long positions entirely. If you wanted to trade silver futures, you could only sell. Buying was forbidden. Simultaneously, margin requirements were raised to levels that made holding existing positions economically impossible for most traders. The Hunt brothers faced margin calls they couldn't meet, were forced to liquidate, and silver crashed from $50 to $10 within 2 months. The parallels to January 2026 are structural, not superficial. In both cases, a sustained rally created existential risk for institutional shorts. In both cases, exchange rule changes and margin increases were deployed to break the rally. In both cases, the timing of those interventions coincided precisely with the moment of maximum danger for established financial institutions. The difference is that in 1980, the exchanges were explicit about changing the rules. In 2026, the manipulation was accomplished through the same mechanisms but presented as routine risk management. The 2011 silver crash provides an even closer parallel because it occurred within the modern electronic trading environment. In April 2011, silver reached $49.82, just pennies below the 1980 high. Retail investors were piling in. Silver forums were predicting $100. The narrative of silver as the poor man's gold was reaching mainstream awareness. And then the CME raised margin requirements, not once, 5 times in 9 days. The first increase came on May 2nd, the second on May 3rd, the third on May 5th, the fourth on May 9th, the fifth on May 11th. Each announcement triggered a wave of forced liquidation. Each wave of liquidation pushed prices lower. Lower prices triggered more margin calls on remaining positions. The feedback loop took silver from $49 to $32 in less than 2 weeks, a 35% decline that wiped out late-arriving retail investors while providing massive profits to commercial shorts. A floor trader who witnessed the 2011 crash described it in simple terms. The exchange was killing the rally. Everyone on the floor knew it, and there was nothing anyone could do because the rules allowed them to do it. The rules still allow them to do it. And in January 2026, they did it again. The palladium squeeze of 2000 to 2001 offers a different lesson. When Russia delayed export licenses for palladium, creating genuine physical scarcity, the paper market and physical market diverged dramatically. Hedge funds bought physical palladium while shorting futures, betting correctly that shorts wouldn't be able to deliver. Multiple firms defaulted. COMEX implemented emergency position limits and forced cash settlements rather than allow the physical squeeze to play out. This is what happens when fractional reserve commodity markets face real delivery demand. The exchanges don't allow price discovery to occur. They change the rules to protect the system, which in practice means protecting the institutions whose short positions would be destroyed by genuine price discovery. The historical record is unambiguous. Every major silver rally of the past 50 years has been terminated by exchange intervention, not by natural market forces. The 1980 rally ended with Silver Rule 7. The 2011 rally ended with 5 margin hikes in 9 days. The January 2026 rally ended with percentage-based margins that automatically increased as prices rose, combined with explicit margin hikes that pushed requirements up 30% in cumulative terms. The mechanism evolves. The outcome remains constant. Retail investors and physical buyers are systematically disadvantaged relative to institutional paper traders who have implicit backing from the exchanges and regulators. Understanding this history doesn't tell you whether silver will recover or crash further, but it tells you that the game has rules, and those rules are not applied equally to all participants. Predicting markets with certainty is a fool's errand. Anyone who tells you they know exactly where silver will be in 3 months is either lying or delusional. But understanding the range of probable outcomes and the signposts that indicate which scenario is unfolding gives you something more valuable than a prediction. It gives you a framework for action. Here's how I see the next 12 months playing out across 3 distinct scenarios. The first scenario is the recovery thesis, and it's the one that historical precedent most strongly supports. Every manipulated crash in silver market history has been followed by a period of consolidation and then a resumption of the prior trend. After the 1980 collapse, silver bottomed at $4.07 in 1993 and eventually reached $49 in 2011. After the 2011 crash, silver bottomed at $13.64 in 2015 and eventually reached $30 in 2020, then $50 in 2024, and then $121 in January 2026. The pattern is remarkably consistent. Crashes create generational buying opportunities for those with the patience and conviction to hold through volatility. If this scenario plays out, here's the likely timeline. Over the next 2 to 4 weeks, silver consolidates in a range between $80 and $100. Weak hands have been flushed. Leveraged longs have been liquidated. Open interest drops 30 to 40% as speculative positions are cleared. This is the capitulation phase, and it's usually the worst time to sell and the best time to accumulate. From weeks 4 through 12, stabilization occurs. Volume normalizes. Volatility decreases. Institutional buyers who were waiting for a pullback begin accumulating quietly. Physical premiums, which spiked during the crash as dealers struggled to source inventory, remain elevated. This divergence between paper prices and physical availability is your signal that the underlying supply situation hasn't changed. From months 3 through 12, the recovery unfolds. Short covering begins as banks that profited from the crash start closing positions to lock in gains. Technical traders see bullish patterns forming on the charts. Momentum returns. Silver recovers 50 to 70% of the crash within 6 months and potentially makes new highs within 12 months. The fundamental drivers that push silver from $30 to $121 haven't disappeared. China's export restrictions are still in place. Industrial demand from solar panels and electronics is still growing. COMEX registered inventory is still depleted. The March delivery period is still approaching with open interest far exceeding deliverable supply. The second scenario is prolonged suppression, and it requires a different set of conditions. If the Federal Reserve maintains higher interest rates through 2026, the opportunity cost of holding non-yielding assets like silver increases. If the dollar strengthens significantly against other currencies, commodities priced in dollars become more expensive for foreign buyers, reducing demand. If global recession fears materialize, industrial demand for silver could decline even as investment demand remains elevated. Under this scenario, silver doesn't crash further but doesn't recover either. It trades in a range between $70 and $100 for 6 to 12 months. Each rally attempt is sold. Each dip finds buyers but not enough to generate momentum. The banks use this period to gradually cover short positions without triggering price spikes. Retail investors grow frustrated and sell at a loss. By the time the next leg higher begins, most of the weak hands have been transferred to strong hands at lower prices. The key indicator for this scenario is the dollar index. If DXY breaks above 110 and holds, silver will struggle. If DXY rolls over below 100, the suppression scenario becomes less likely. Watch the dollar more than you watch silver. The third scenario is systemic fracture, and it's the one that most analysts refuse to discuss. The January 30th crash exposed something that cannot be unexposed. The paper silver market and the physical silver market are no longer telling the same story. On January 1st, while COMEX showed silver at $72, physical dealers in Asia were selling at $130, an 80% premium that has never occurred in modern markets. This divergence briefly narrowed, but hasn't disappeared. If large industrial users and sovereign buyers conclude that COMEX prices are unreliable indicators of physical availability, they'll bypass the exchange entirely. We're already seeing this. Samsung secured exclusive rights to 100% of production, from a Mexican silver mine through direct offtake agreements. Tesla has reportedly approached primary silver producers about similar arrangements. These companies aren't buying paper contracts and hoping for delivery. They're locking up physical supply at the source, removing it from the exchange system permanently. If this trend accelerates, COMEX becomes increasingly irrelevant for price discovery. The reference price for silver shifts to Shanghai, or to direct producer-consumer transactions, or to a physical premium market that operates outside exchange structures. For investors holding paper silver through ETFs or futures, this is catastrophic. For investors holding physical metal, it's validation. Watch the premium spread between paper and physical prices. Watch COMEX registered inventory levels. Watch for announcements of direct offtake deals between industrial consumers and miners. These are your early warning indicators that the third scenario is unfolding. Analysis without application is entertainment. You didn't watch this far to be entertained. You watched because you want to know what to do. Let me break this down based on where you're currently positioned. If you owned silver before January 30th, here's what you need to understand. You just experienced the most violent single-day decline in 46 years. Depending on when you bought, you might be looking at significant paper losses. That hurts. I'm not going to pretend it doesn't. But let me give you some perspective that the panic-inducing headlines won't provide. Your physical silver didn't change. If you held 100 ounces on January 29th, you hold 100 ounces today. The number of atoms didn't decrease. The industrial applications didn't disappear. Solar panels still need silver for their contacts. Electronics still need silver for their conductors. Medical devices still need silver for its antimicrobial properties. The demand side of the equation is unchanged. What changed is the paper price, which is set by a futures market that just demonstrated its disconnect from physical reality. When COMEX silver shows $85 and physical dealers are charging $130, which price is real? The paper price is what gets reported. The physical price is what you pay when you actually try to buy metal. For holders of physical silver, the crash in paper prices is an accounting event, not an economic event. Do not sell physical silver at the bottom of a manipulated crash. That is precisely what the institutions who engineered this crash want you to do. They need sellers to cover their positions. They need panicked retail investors dumping metal into a market they control. Every ounce you sell at $85 is an ounce they acquire at $85. When silver recovers to $120 or $150 or $200, they will sell those ounces back to the market at a massive profit. Don't be the exit liquidity for bank trading desks. If you don't own silver but have been considering it, here's your framework. The crash created an entry point that didn't exist 2 weeks ago. Silver at $85 is not the same proposition as silver at $121. But don't mistake a lower price for a risk-free opportunity. The same forces that crashed silver from $121 to $85 can crash it from $85 to $60 if that's what's required to shake out remaining long positions. Volatility is not your friend when you're fully allocated. The intelligent approach is dollar cost averaging. Divide whatever amount you've allocated to silver into 4 to 6 equal portions. Deploy them over 3 to 6 months. If silver drops further, your average cost drops with it. If silver recovers immediately, you participate in the upside. This approach sacrifices maximum returns for reduced risk, which is almost always the right trade-off for individual investors. Buy physical metal, not paper claims. This crash proved why. When the system is stressed, paper claims can be settled in cash, revalued arbitrarily, or simply defaulted upon. Physical metal in your possession cannot be rehypothecated, cannot be settled in cash against your will, and cannot be confiscated by a brokerage in bankruptcy. The premium you pay for physical overspot is insurance against counterparty risk. After January 30th, that insurance looks cheap. Focus on recognizable sovereign coins if liquidity matters to you. American Silver Eagles, Canadian Maple Leafs, Austrian Philharmonics. These trade at tighter spreads when you eventually sell because buyers trust government mint authenticity. Generic rounds and bars are fine for pure metal accumulation at lower premiums, but they'll trade at discounts when you sell. Expect delays. Dealer inventories were already strained before the crash. The surge in buying interest following the price decline has overwhelmed many retailers. If a dealer quotes you immediate availability at spot plus a small premium, be skeptical. The dealers with inventory are charging significant premiums because the market supports those premiums. If it sounds too good to be true, verify before you send payment. If you're worried about the broader financial system, expand your preparation beyond precious metals. Silver is a symptom of monetary dysfunction, not a cure for it. Holding physical metal protects you from currency debasement and banking system instability, but it doesn't feed you during supply chain disruptions, keep your lights on during grid failures, or provide liquidity during a banking holiday. A comprehensive resilience plan includes physical cash on hand, shelf-stable food supplies, water filtration capability, and relationships with local producers and suppliers. This isn't paranoia, this is risk management. The same institutional recklessness that created the 2008 financial crisis, the same leverage and opacity and regulatory capture, exists today in different forms. The silver market just gave you a window into how fragile the system becomes when paper promises collide with physical reality. That collision is coming to other markets. It may have already started. The silver crash of January 30th, 2026 will be remembered as either a violent shakeout within a continuing bull market or the first crack in a broader financial restructuring. I don't know which interpretation history will validate. What I know is that the institutions who control the paper markets are fighting to maintain that control, and the forces demanding physical delivery are not retreating. Position yourself for both outcomes. Hold physical metal for the monetary reset scenario. Maintain liquidity for the buying opportunities that volatility creates. And above all, understand that the game is not fair, the rules favor incumbents, and your only edge is knowledge they assume you don't have.